Ladies and gentlemen, Asian guy here. Eliminate every distraction, close every browser tab, because what I'm about to disclose will completely transform how you comprehend what's occurring in the silver market right now. This isn't speculation. This isn't theory. This is documented action executed by one of the largest economies on Earth. Action that exposes a crisis so severe that regulators possessed no selection but to intervene with emergency measures. And if you don't comprehend what this intervention actually means, you're about to misinterpret the most significant signal the precious metals market has provided us in over a decade. Right now, silver is trading at $85.15 per ounce. Gold is sitting at $4,918. And I need you to comprehend something critical before we go any further. These prices aren't the ceiling. They're not even close to fair value. They're the battlefield where command is being fought over in present time. Because while you were observing charts and checking your portfolio, something unprecedented just occurred. The Chinese government, without warning and without apology, shut down 5 separate commodity funds in a single trading session. Not for minutes, not for a cooling off period, complete trading suspension. The only silver futures fund available to mainland Chinese investors, locked for an entire day. 4 oil-focused funds frozen simultaneously until further notice. This wasn't maintenance. This wasn't a technical issue. This was an emergency response to what regulators openly described as systemic risk and imminent massive investor losses. And here's what makes this instance different from every other time regulators have stepped in. This is the second emergency shutdown in 8 days. Whatever they reasoned, they fixed on January 22nd clearly didn't function. The problem came roaring back with enough force that they possessed no selection but to slam the brakes again. When the second largest economy on the planet initiates implementing emergency trading halts because commodity demand has spiraled beyond their command, you don't obtain to dismiss it as regulatory overreach. You don't obtain to call it China being China. Because what's occurring in their markets is a direct reflection of pressure constructing everywhere. And that pressure is about to discover new outlets. I'm here to demonstrate you precisely what those outlets are. And more significantly, how to position yourself before the next phase detonates. Now, before we dissect what this means for your prosperity, I need you to execute something for me. If this breakdown is providing you clarity that nobody else is presenting, hit that like button right now. It assists this communication reach people who desperately need to perceive it. And subscribe if you haven't already, because what's coming in February is going to separate the prepared from the blindsided. Let me walk you through precisely what occurred, because the specifics disclose everything. On January 30th, Chinese financial authorities executed what can only be described as coordinated emergency suspensions across multiple commodity investment vehicles. The most significant target was the UBS SDIC Silver Futures Fund. This isn't some obscure regional product. This is the only public fund in all of mainland China that directly invests in silver futures. The only one. When 1.4 billion people possess precisely one regulated option for silver futures exposure, and that option obtains shutdown for an entire trading day, you're not observing routine market management. You're observing panic containment, but it deteriorates. At the exact identical instance, 4 separate oil-focused listed open-ended funds obtained hit with synchronized suspensions, each one frozen until 10:30 a.m. Beijing time. The coordination is the signal. When regulators shift on multiple funds simultaneously across different commodities, they're not responding to isolated problems. They're responding to systemic breakdown. So what fractured? What compelled their hand? The answer is premiums, specifically the gap between what investors were compensating for fund shares versus what the underlying assets were actually worth. And the numbers are absolutely insane. The UBS SDIC Silver Futures Fund was trading at a 36% premium to net asset value. Let me state that again so you comprehend the magnitude. Investors were compensating 36% more than the actual silver futures were worth just to obtain exposure through this fund. Consider what that means in practical terms. If you purchased shares at that premium and the underlying silver futures remained completely flat, you would be sitting on an immediate 36% loss the instant the premium normalized. You weren't purchasing silver. You were purchasing desperation. You were purchasing the fear of overlooking at any price. Chinese retail investors were so desperate to obtain silver exposure that they were willing to compensate more than a third extra just to obtain in the door. They weren't questioning what the metal was worth. They were questioning how rapidly they could obtain positioned before it ran away from them. And regulators perceived precisely where that conduct was heading. They perceived retail currency piling in at mathematically unsustainable prices. They perceived the feedback loop constructing. The higher the premium went, the more momentum chasers interpreted it as confirmation that silver was the hottest trade on the planet. So they piled in more difficult, which pushed the premium higher, which attracted more momentum chasers. This is the death spiral that regulators determined to cease before it consumed the entire retail investor base. Not because they're anti-precious metals, not because they desire to suppress prices, but because they comprehended that when that premium inevitably collapsed, the losses would be catastrophic for millions of people who possessed no idea what they were actually purchasing. Now here's the question nobody in the financial media is questioning. Why was demand so extreme in the first location? Why were Chinese investors willing to compensate 36% premiums when they could have just awaited? The answer discloses everything about where we are in this cycle. Silver has been on an absolute tear. In the last 30 days alone, silver has surged 58%, not 5%, not 15%, 58%. We're discussing prices that pushed toward $118.58 per ounce at the peak, levels that would have seemed delusional just 6 months ago. Gold has been running equally hot, up 22% and approaching $5,600 per ounce. Oil has broken through resistance with Brent crude hitting 5-month highs above $70 per barrel. This isn't random price action. This isn't sector rotation. This is a coordinated flight into hard assets driven by forces that are accelerating, not decelerating. First, there's the monetary policy chaos. Central banks have been whipsawing between aggressive cut expectations and higher for longer rhetoric. Every time traders price an easier currency, the dollar deteriorates, genuine yields compress, and precious metals catch a bid. Every time hawkish comments return, we obtain violent pullbacks. This back and forth has generated extreme volatility, and that volatility obtains amplified through leveraged instruments like the funds China just suspended. Second, there's the geopolitical overlay. U.S. naval positioning near Iranian waters. Escalating tensions across multiple theaters, energy supply chains appearing vulnerable. When traders initiate pricing conflict risk into oil, and when investors initiate hedging currency debasement through precious metals, you obtain the type of demand surge that overwhelms normal market infrastructure. Third, there's the structural supply crisis that almost nobody is connecting to current prices. Silver isn't merely a monetary metal, it's an industrial workhorse. Solar panels consume silver, electric vehicles consume silver, 5G infrastructure consumes silver. The green energy transition that every major government has committed to is fundamentally silver intensive, and supply has not maintained pace with this structural demand expansion. When you combine monetary demand, safe haven demand, and industrial demand all hitting simultaneously, you don't obtain orderly price discovery. You obtain the type of violent movements we've been witnessing, and when that demand obtains, funneled through a single investment vehicle serving 1.4 billion people, you obtain 36% premiums and emergency trading halts. Now I desire to demonstrate you something that proves this isn't isolated to China. Because what occurred in Beijing is a symptom of pressure constructing everywhere. The gold-silver ratio, which measures how many ounces of silver it requires to purchase 1 ounce of gold, has compressed to its lowest level since 2011. That compression isn't occurring because gold is collapsing. It's occurring because silver is executing catch-up in a dramatic way that historically signals major regime transformation. At the identical time, physical silver demand has been exploding globally. One major dealer reported a 158% increase in sales of 1 ounce silver coins in less than 4 months, a 550% increase in demand for 1 kilogram silver bars over the identical period. Google searches for how to buy silver and buy silver online have spiked 250% in recent months. This isn't niche interest, this is mass awakening. People are examining ways to obtain precious metals exposure outside the traditional financial system. And physical accumulation is one of the clearest expressions of that impulse. So when Chinese regulators shut down their only silver futures fund, that demand doesn't disappear, it redirects. Some of it flows into physical silver, some of it flows into Hong Kong listed products, some of it flows into gold as an alternative, and some of it generates pressure on international markets as capital discovers other pathways. This is the critical point that everyone is overlooking. The trading halt didn't destroy demand, it just compelled that demand to discover new routes. And every new road it discovers generates additional pressure on global supply chains that are already stretched to the breaking point. Let me demonstrate you the smoking gun that proves this entire thesis. Usually, when a market crashes or obtains halted, it triggers a feeding frenzy on the short side. Hedge funds smell blood, algorithms pile in, they borrow shares and attempt to ride the price down. And when that occurs, the expense to borrow shares skyrockets because everyone is combating for the identical inventory. But right now, the borrow fee for SLV, the largest silver ETF in the world, is sitting at basically zero, rock bottom. And there are millions of shares available to borrow, just sitting there collecting dust. Nobody desires them. Nobody's shorting. Do you comprehend how insane that is? China just implemented emergency trading halts. The narrative should be that the silver rally is over, that regulators are clamping down, that the trade is crowded and vulnerable, and yet the intelligent currency is refusing to bet against it. Why? Because hedge fund managers aren't foolish. They're examining the identical data we just examined. They perceive the 58% movement in 30 days. They perceive the physical demand explosion. They perceive the structural supply deficit. They perceive Chinese demand obtaining redirected into other markets. And they understand that shorting silver right now is like standing in front of a freight train holding up a piece of paper that states, "Stop." The freight train is global demand for hard assets. And if you stand in front of it, you don't obtain wealthy. You obtain obliterated. This informs us precisely who's responsible for any price weakness we're perceiving. It's not the market. It's not institutional liquidating. It's a small handful of bullion banks dumping contracts to maintain the price contained. They're naked shorting positions they don't possess because they're desperate to cap the price and protect dollar credibility, but they're isolated. The rest of the financial world is standing on the sidelines, refusing to join them because the intelligent currency understands this $85 price isn't a ceiling. It's a coiled spring. In the instance the suppression ceases, the arbitrage will wake up and the price will gap violently higher. Now I need to discuss the oil side of this narrative because it's connected to silver in ways that most people are completely overlooking. Remember, China didn't merely suspend the Silver Futures Fund. They hit 4 separate oil-focused funds at precisely the identical time. That coordination is the tell. When regulators shift simultaneously across different commodity sectors, they're perceiving the identical sequence executing everywhere. And here's what that sequence resembles. Brent crude broke above $70 per barrel for the first time in 5 months on the exact day these suspensions occurred. That breakout coincided with U.S. naval vessels positioning near Iranian waters. The market was pricing geopolitical risk premium directly into energy prices, and Chinese investors were pursuing that trade through oil-focused funds with the exact identical momentum conduct they demonstrated in silver. Let me demonstrate you the feedback loop that regulators were attempting to fracture. When geopolitical tensions elevate, commodity prices elevate. When commodity prices elevate, retail investors pursue. When retail investors pursue through concentrated fund structures, premiums expand. When premiums expand beyond sustainable levels, regulators intervene. But here's the critical aspect that everyone is overlooking. The intervention treats the symptom, not the cause. The geopolitical tensions are still there. The supply vulnerabilities are still there. The demand is still there. Suspending trading for an hour doesn't make those forces disappear. It just compresses them temporarily. This is why I believe the oil narrative is far from over. And more significantly, it's why the oil narrative validates everything we're perceiving in precious metals. Because they're both being driven by the identical underlying force, loss of confidence in paper systems, and flight into physical assets. Consider what oil and silver possess in common. They're both strategic commodities. They're both essential to modern infrastructure. They're both vulnerable to supply disruptions. They're both traded in markets where paper contracts massively outnumber physical delivery capacity. When those markets come under strain, when demand surges faster than supply can respond, when geopolitical risk makes future availability uncertain, investors initiate questioning whether their paper exposure will actually convert to physical delivery when it matters. That's when premiums explode. That's when funds initiate trading at 36% above net asset value. That's when regulators panic and shut everything down. But shutting down trading doesn't generate more oil. It doesn't generate more silver. It just conceals the supply crisis temporarily behind regulatory curtains. And here's what occurs next. The pressure constructs. The demand discovers alternative routes. The premiums manifest in different markets, Hong Kong, Singapore, London, wherever Chinese capital can flow without restriction. This is already occurring. We're perceiving it in the physical silver premium data. We're perceiving it in the compressed gold-silver ratio. We're perceiving it in the refusal of institutional currency to short despite apparent vulnerability. The intelligent currency comprehends what regulators don't desire to admit. You can suspend trading. You can implement cooling off periods. You can restrict new fund purchases, but you cannot suspend the fundamental forces driving demand. And you cannot manufacture physical supply with regulatory decree. So when I examine China's intervention, I don't perceive the termination of the commodity rally. I perceive confirmation that the rally has obtained robust enough to threaten systemic stability. And that informs me we're nowhere near the top. Because if we were near the top, regulators wouldn't need to intervene. Weak hands would be liquidating naturally. Premiums would be compressing on their own. The market would be discovering equilibrium without emergency measures. The fact that they had to shut down trading twice in 8 days informs you the opposite. It informs you that demand is so relentless, so overwhelming, that normal market mechanisms can't handle it. And when normal mechanisms can't handle demand, that demand doesn't disappear. It just obtains more creative about discovering outlets. Now, let me address the elephant in the room because I understand some of you are reasoning it. Yes, silver possesses momentum. Yes, the fundamentals appear supportive. Yes, China's trading halt discloses genuine demand pressure, but markets that run this rapidly are also prone to sharp corrections. The identical volatility that generates 58% gains in a month can generate 30% drawdowns in a week. Some analysts have projected silver reaching $150 within 3 months. That's a bold call, and it might be correct, but it's also the type of projection that tends to manifest near cycle tops rather than bottoms. When major institutions initiate publishing aggressive upside targets, it's frequently a signal that retail enthusiasm is peaking. I'm not stating liquidate everything. I'm not stating the rally is over. I'm stating be aware of where we are. The easy currency has been made. The evident trade has been executed. What comes next requires more nuance, more patience, and more discipline. If you're already positioned in silver, this is probably a time to reason about risk management rather than adding at extended prices. If you're not yet positioned, this is probably a time to await pullbacks rather than pursuing momentum at 52-week highs. The people who construct genuine prosperity in these markets are the ones who purchase fear and liquidate greed. Right now, there's substantial greed in the silver market. That doesn't mean the bull run is over. It means the next phase will require more ability than the first phase. But here's what I desire you to comprehend about China's intervention. This isn't the termination of the narrative. This is the beginning of a sequence. When commodity markets obtain hot enough to threaten systemic stability, regulators will intervene. They'll suspend trading. They'll restrict new purchases. They'll implement cooling-off periods. They'll execute whatever they reason is necessary to prevent retail investors from destroying themselves. That doesn't mean the underlying trend is incorrect. It means the trend is robust enough to frighten authorities. And when trends obtain that robust, they tend to possess more room to run once the intervention pressure eases. The historical precedent is clear. Every major precious metals bull market has featured regulatory interventions along the way. The 1970s bull run in gold possessed multiple instances where authorities attempted to cool the market. The 2000s run featured similar dynamics. Each time, the interventions generated temporary pauses, but didn't reverse the fundamental forces driving prices higher. I'm not stating history will repeat precisely. I'm stating the sequence of intervention during robust bull markets is normal, not exceptional. If you're utilizing China's trading halt as a reason to panic out of positions, you might be misreading the signal entirely. Let me provide you a framework for reasoning about what comes next, because frameworks are more useful than predictions. First, recognize that China's trading halt is a signal, not an endpoint. It informs you that demand for commodity exposure has exceeded the infrastructure's capacity to handle it smoothly. That type of demand doesn't disappear when you suspend trading. It redirects. It constructs pressure, and eventually that pressure obtains released. Second, comprehend that premiums and discounts in fund structures are information. When a fund trades at a 36% premium, the market is screaming something about desperation levels and supply constraints. That information is valuable, even if you never trade that specific fund. Third, differentiate between trading and accumulating. If you're trading short-term, this is an environment that rewards patience and punishes pursuing. Await pullbacks. Don't compensate premium prices for exposure. You can obtain cheaper next week. If you're accumulating long-term, short-term volatility matters less. You're purchasing the decade-long thesis about currency debasement, industrial demand, and hard asset repricing. In that framework, temporary suspensions in Chinese funds are commotion, not signal. Fourth, pay attention to the physical market. When fund trading obtains disrupted, physical metal becomes more attractive. The premiums dealers charge for physical silver and gold are information. When those premiums expand, it informs you the physical market is tightening. When they compress, it informs you supply is catching up with demand. And right now, the physical market is screaming, let me demonstrate you the data that nobody is connecting. Major dealers are reporting unprecedented demand sequences, 158% increase in 1-ounce silver coin sales in less than 4 months. 550% surge in 1 kilogram bar purchases over the identical period. These aren't marginal increases. These are panic purchasing levels. But here's what makes this data even more significant. This physical demand explosion is occurring simultaneously with China's fund suspensions. Consider what that means. Chinese investors can't obtain futures exposure through their preferred fund. So where is that capital going? Part of it is flowing into physical metal. Part of it is discovering alternative paper vehicles. But the physical component is genuine and measurable. When you shut down paper access in the world's second largest economy, you don't destroy demand. You redirect it into channels that are even more difficult to suppress. Physical metal doesn't possess trading halts. Physical metal doesn't possess fund managers who can block purchases. Physical metal is the ultimate escape hatch from financial system command. This is why I maintain emphasizing the significance of observing dealer premiums. When premiums on physical metal initiate expanding significantly above spot prices, it's informing you that the paper price is disconnected from physical reality. It's informing you that people are willing to compensate more than the official quote, just to secure actual possession. And we're initiating to perceive those premiums tick up in certain markets. Not everywhere yet, not uniform across all products, but the trend is forming. And if Chinese demand continues redirecting into physical channels, those premiums will expand further. This generates a self-reinforcing dynamic that regulators cannot cease. The more they restrict paper trading, the more demand flows into physical. The more demand flows into physical, the tighter the physical supply becomes. The tighter physical supply becomes, the wider premiums expand. And wider premiums validate the thesis that paper prices are artificial, and physical possession is what matters. You cannot regulate your way out of a supply crisis. You cannot suspend your way out of fundamental demand, and you cannot wish away the consequences of decades of underinvestment in mining capacity while industrial consumption accelerates. China's intervention is attempting to manage symptoms while disregarding causes, and that approach has never functioned in commodity markets. Not in oil, not in copper, not in agricultural products. And it won't function in silver. Fifth, observe the gold-silver ratio closely. This metric has been one of the most reliable signals in the precious metals complex for decades. When it reaches extremes and initiates to mean revert, the movements can be powerful. We're in one of those reversion phases right now. Whether it continues or reverses will inform you substantially about where we are in the cycle. Now let me discuss what I reason is actually occurring beneath all of this volatility. What we're observing right now is a stress examination of global commodity market infrastructure. The combination of geopolitical uncertainty, monetary policy confusion, and structural demand expansion is pushing markets in ways they weren't designed to handle. China's response of suspending trading is one approach. Other jurisdictions may respond differently, but the underlying pressure is identical everywhere. And that pressure tends to produce something very specific over time. It produces repricing. It produces revaluation. It produces a fundamental shift in how people reason about what's valuable and what's risky. Paper assets that seemed safe initiate to experience fragile. Hard assets that seemed old-fashioned initiate to experience essential. Fiat currencies that seemed stable initiate to experience experimental. Physical commodities that seem tedious initiate to experience strategic. That's not a prediction about next week or next month. That's an observation about where we are in a multi-decade cycle. The people who recognize these cycle shifts early are the ones who position themselves for generational prosperity transfer. The people who dismiss them as commotion are the ones who obtain left behind holding devalued paper. Here's my question for you, and I desire to perceive this discussion in the comments. Do you reason China's trading halt is a warning signal that the silver rally has gone excessively far? Or do you reason it's confirmation that demand is so robust that even regulators can't contain it? There's no incorrect answer, but your answer discloses how you're interpreting this instance, and that interpretation will shape your positioning going forward. Drop your reasoning below, and if you've been navigating this precious metals rally successfully, share what's functioned for you. Genuine world feedback from this community is valuable for everyone observing. Let me leave you with one final reasoning that captures where we are. When authorities intervene in markets, they're informing you something significant. They're informing you that the market has obtained robust enough to frighten them. And when markets frighten authorities, it's typically because something fundamental has shifted. The structural forces driving precious metals demand aren't going away. Currency debasement concerns aren't going away. Geopolitical uncertainty isn't going away. Industrial demand for silver and green technologies isn't going away. Central bank accumulation of gold isn't going away. These are multi-year themes, not multi-week trades. And if you're positioned for the multi-year narrative, the day-to-day commotion of regulatory interventions and volatility spikes becomes much easier to navigate. Let me provide you one more framework for reasoning about this instance, because I reason it captures something essential that's easy to overlook in all the chaos. Markets shift in cycles. Bull markets, bear markets, consolidation phases, breakout phases. And within those larger cycles, there are smaller sequences. Regulatory intervention is one of those sequences, and it tends to occur at specific points in the cycle. Early in a bull market, when prices are just initiating to shift, regulators don't care. The movements are small, retail participation is limited, there's no systemic concern. But as the bull market matures, as prices accelerate, as retail enthusiasm constructs, as leverage enters the system, regulators initiate paying attention. They perceive the premiums expanding. They perceive the momentum pursuing. They perceive the leverage ratios climbing. And they make a judgment call. Do we permit this to run and risk a catastrophic bust? Or do we intervene now to contain the damage? China selected intervention. They perceived 36% premiums and stated, this has gone excessively far. We need to protect retail investors from themselves. That determination informs us something critical about where we are in this cycle. We're not early. The easy currency has been made. But we're not late either. If we were late, if we were near the top, premiums would be compressing naturally. Weak hands would be liquidating into strength. The intelligent currency would be heading for the exits. That's not what's occurring. The intelligent currency is refusing to short. Physical demand is accelerating. The gold-silver ratio is informing us silver possesses more room to run relative to gold. And Chinese demand, despite being blocked from their preferred channel, is discovering alternative outlets. This is the middle phase of a major bull market, the phase where volatility increases, where regulatory attention intensifies, where weak hands obtain shaken out, but where the underlying trend remains intact and powerful. The people who construct generational prosperity are the ones who can navigate this middle phase without panicking, the ones who can separate commotion from signal, the ones who comprehend that intervention doesn't mean invalidation. China's trading halt isn't informing you to liquidate. It's informing you that demand has obtained robust enough to frighten regulators. And when demand frightens regulators during a bull market, history suggests you pay attention to what that demand is informing you, not what the intervention is attempting to suppress. Don't confuse intervention with defeat. Don't confuse temporary suspensions with trend reversal. And don't permit short-term commotion to steal your conviction when the long-term thesis remains intact. This is the Asian guy. It's Friday, January 30th, 2026. Silver is at $85.15. Gold is at $4,118. China just shut down their only silver futures fund for the second time in 8 days. Physical demand is exploding globally. The gold-silver ratio is at levels we haven't perceived since 2011. And the intelligent currency is refusing to short, despite all the apparent chaos. If this breakdown assisted, you perceive through the commotion and comprehend what's actually occurring, remember to like the video, subscribe to the channel, and share this with someone who needs to hear it. Remain sharp. Don't permit intervention commotion to shake your conviction. And I'll perceive you in the next one.